Hello, Mr. Inyoluabuiji, are you on? Hello, Inyoluabuiji, are you on the call now? Um, Good everyone. Good everybody all across from Africa, different places. This is KWARABUILD 20. Uh, we are having such an awesome conference on the Africa's next builders, and this is the last session of the program. Uh, it's nobody to say that there's been a jolly good ride all along, and in this panel session, we'll be discussing something that is very crucial to our ecosystem as uh, tech people and tech professionals and tech enthusiasts. Everybody has ideas, the ideas in different forms and there are different ways, but then crucial to you know acting out your idea, making the ideas come to reality is securing funds to build sustainable enterprises. And today we have awesome speakers who will be part of the session, accomplished people who have built startups and good businesses all across Africa, and investors too. So it's nice to have everybody on board here. So I need you all to pay attentive from wherever you are watching live, whether it's our YouTube channel, our Facebook channel, or Periscope. Just pay attention. And if you have questions, let them come in the comment section. So right now, sit already. Have Inyolua Boiji, we have Ibrahim Jegatu, and we'll be getting on. So in a bit, I will introduce our speakers who are available. Starting with Ibrahim Jega. Um, Ibrahim Jega is a serial tech entrepreneur and tech-savvy marketer. He co-founded Dominion Enterprises, a blockchain-enabled registry and real estate solutions company. He's also the Chief Business Development Officer at VokePay, an online payment processing company. And he is a community volunteer at Startup Arewa. And also, I'd like to know that he is the founder of Startup Arewa too. And he has been involved in so many NGOs. Mohammed bagged his first degree in business administration from the prestigious Ahmadu Bello University and graduate of commerce, and he had his master's in information systems too, the same university. He has attended various trainings locally and internationally in business development, marketing, project management, a whole lot of other interesting fields. We are glad to have him on board here. Mohammed, can you say?
Hello, thank you very much for having me. It's my pleasure to be here.
Oh, wow. Thanks, Mohammed. Inyolu Abueji is the general partner and co-founder of Future Africa, a platform that enables capital, coaching, and community for founders and mission-driven innovators who are building businesses and companies in Africa. Prior to starting Future Africa, he served as the deputy director for the Madam Obieze Kwesili 2019 presidential campaign team in Nigeria. He also helped build Andela and Florida Wave, two of the Africa's largest and fastest growing companies, global investors. Inyolua is popularly known as E in the tech community, and he holds a bachelor's degree in legal studies from the University of Waterloo, and is a world economic from young global leader. He sits on the board of a number of corporate and profit organizations and advises a number of national and subnational governments across Africa on how to support high growth, innovation driven enterprises in their domain. Inye, can you say hi?
Yes, I'm sorry. I was in a very noisy place, but I'm just
Oh,
going to somewhere I can talk in the car. But yes, hello
oh,
everybody. Excited to be part of your program. Looking forward to sharing thoughts. Thank you.
yeah, yeah, thanks. Okay, that's fine. Um, without missing words and without wasting time, we'll get into the business of the day. Anytime in Yolua will be at a place where we'll be able to answer
No, don't
questions.
worry. You can start asking the
Oh,
questions. I'm
wow,
just saying
that's nice.
I was in a place that was noisy, so it's fine.
Oh, okay, there's no problem then. I think we'll just get started. So my first question I'll be asking in Yolua, the first question, and you know, for a while now, for years, so much has been said about how our ecosystem, this environment in Africa, is different from our more advanced ecosystems. I mean, pretty built in Silicon Valley, in Europe, and UK, and how disadvantaged we could be, and also the advantages that exist in our environment. So, can you give ideas basically on how Africans can raise funds?
Um, I, sorry, the last question you were asking, how is it different? Is that what you're asking?
No, I was just
Yeah.
stating the fact that it's obviously different from the Europe,
Yes.
Silicon Valley, and other advanced ecosystems. So
Mm-hmm.
I was going to ask, since we are very sure it's different, so how can we, take charge of the advantages and turn the disadvantages into benefits in order to raise
That's a great.
funds effectively?
Well, that's a great question. I mean, the one thing I would say is I don't necessarily agree with the thought that our innovation environment is different. I think it's a lot earlier than other ecosystems. But if you really look on the long arc, we're just going through what some other ecosystems have gone through already over the last, 50 years. So it's just a lot earlier. That said, every every technology revolution is slightly different. So in that way, you can't just imagine that what happened in Silicon Valley or the circumstances around which their innovation happened would transfer here immediately or um, a la carte. But um, but the reality is that you know we're earlier, so that imbues us with certain advantages, including the ability to build businesses that are high growth, businesses that are high growth, businesses that are more fundamental, if you can say so. So, for example, one of the areas where we've seen remarkable progress, at least judging from the fact that two of the panelists on this call are in the fintech and payment space, is payments, right? Um, Today, if you try to build a payment company in the US, you would have to have a pretty good value prop. But today, and lots of funding. But today, the reality is that you know in Africa, it's relatively easy to build a sustainable payments business. So that's an example of some of the benefits of being as early as we are in our innovation cycle, that we can take on some more fundamental problems and succeed. Um, so I think we should all be taking advantage of that, but we should also be maintaining that long-term view that this is still all very, very early and that there's still a lot of room for improvement.
Yeah, yeah, thanks. That was insightful. And sincerely, we are still very early, like you said. And that brings me to the next question, which I would like to, from your point of view, I'll be asking Ibrahim the next question. Like, what was his experience? Pretty much, he was early enough with Vogue Pay, building a payments company. What was his experience like? Just briefly, Ibrahim, can you say something?
Thank you very much. I'm excited to be part of this conversation in as much as the topic of the conversation is about easy ways to raise capital for a business. There is no any easy way, but the easy way, it's all about how you structure and how you define your value proposition. I quite agree with some of the pointers Ian gave. In business, if you want me to share the VokePay story, the model we took was bootstrapping our business. There are different models of fundraising. One of it is bootstrapping your business and also launching a crowdfunding campaign or applying for a loan or raising capital to friends and family. Also, you can also find an angel investor. And the sixth one is getting investment from venture capitalists. But the model that we took at VokePay was bootstrapping. We bootstrapped the business because we all know that money doesn't grow on trees, and there are a number of ways, traditional funding for businesses and what have you. But what we did was to see how we could be able to define our business model, because business isn't operating in industry to understand the terms. For instance, if you don't have enough savings to run your business operation, you could actually, with 0% APR business credit, you can be able to offer chance to borrow for cash and also to incur interest. Perhaps, funding businesses have different, its own demographic. But the model we took was to see how best we could be able to bootstrap, to manage what we have in terms of investing our own time and also using our own skill to build capacity around that business for a long time. As it is, for the past 10 years, we've not raised any kobo up to now. We are one of the few payment companies that have not raised any investment because we decided to see how best we could change the game in terms of using what we have to be able to be, because everybody has its own vision. A lot of businesses have their own entry point, have their own value proposition, where they see themselves and what they intend to achieve. So the model FilterWave use might not be the same model VokePay is using. The model Paystack is using is the same model, but we're Africans, we're trying to solve a problem where that's the unique proposition, and we're trying to see how we can be able to support businesses to be able to receive and send money irrespective of their location. So most importantly, the model we use at VokePay, which we still on it, is we bootstrapped our business. We bootstrapped our business.
Thanks for the few words you just gave us about the early stage and even the current situation concerning funding VokePay to run one of the biggest payment processing platforms in the country. And that takes me to the next question. And I'll be asking Ibrahim, and I would like that you speak generally on doing business at Africa, generally, or raising companies. Fundamentally, when it comes to building businesses, when it comes to running companies or whatever, it all starts from the idea. You understand? And I would like to ask, when you have your idea or when you're already making your ideas come to a reality, along the line, when exactly do you decide or do you think it is necessary to raise funds? At what exact time can someone say, okay, based on the idea I have now, it's time that I can raise funds or power the idea?
Yeah, I mentioned earlier actually about different business model, different people having their own perspective about their businesses. I told you the workplace story. We're 10 years in the space, but we've not raised funding. It's our own concept. It's our own value proposition trying to say that we don't want to raise money, right? So somebody can have an entry point. He has not even started a business. The idea is on his laptop, but to shock you to see him raising money. I've come across a lot of startups who have ideas on their laptop, but they've already raised money. So it's a whole different ball game. It varies from the different business proposition and also individual perspective towards what he intends to achieve. Where does he see himself in the next 1 year? What does he want? Some people feel they are coming to their entry point is that they want to start after 2 years when they have an MVP, then they go and raise funds. Some feel they want to start, build capacity, then expand before they now look for funds. Some at the middle of the journey, they look back and said, wow, we can't go on to the next step. We need to raise funding. And the different models of funding, as I mentioned earlier, there's crowdfunding, there's angel investment, and there's venture capitalists. So those different model business has their own different perspective in their approach. You can't use the crowdfunding approach for the VC. You can't use the VC approach for the angel, because what the angel is looking for is different from what the VC is looking for. And what these two investors are looking for are different from the model that other people are using in crowdfunding. I've seen a lot of startups raising money from crowdfunding, and they've been successful because that's their business model. That's how they've designed their businesses and how they intend to make impact in trying to raise funding. I actually just giving you this perspective based on the experiences I have in the landscape, in the general startup ecosystem landscape, because I understood it's not a general time. You will not say, oh, FlutterWave has gone to raise money, so I also am going to raise money. If you go into that route, you might get a knock on your head because they've prepared, they've designed, they've done, they know what they've done in terms of activating and designing whatever they intend to achieve. So most importantly, I always try to see how I can advise startups to be able to think beyond themselves. What is the big picture? What do they intend to achieve? Understanding the problem they are first, understanding the solution they're providing first, and understanding their markets is very critical. A lot of startups come in, they just have conceived an idea, and that idea is not even an MVP, but they feel that they want an investor, they want an investor. An investor is not just looking for an idea to put his money in, because there's a lot of risk involved. He needs to understand he's investing in you. You need to tell him what you have done in terms of what is your own equity contribution in trying to drive this project, your idea, and trying to convince him to invest in you. So many people, you don't have startups who become they don't have ethics about business, no corporate governance. They don't even understand what is there to run business. You have an appointment with a startup, he wakes up anytime he wants, and he wants to call you anytime. It doesn't work like that. It doesn't work like that. I always advise them to look at their own self, define themselves, take the right step, and they can be able to make it happen. Because you can't mix Peter and Paul. They're independent people. So it all depends on your value proposition, what you intend to achieve. I'm just speaking on a general perspective, because if I intend to dissect it, we might take longer time, so that I'll allow other speakers to talk, their contribution.
Well, thanks. Thank you, Brian. And I think the key point I'm taking from there is what determines when you raise funds is you having an understanding of what industry you are in, what exactly you are trying to do with your company, and the environment and the market. Oh, so I'll be asking the next question.
What I'm saying is that understanding it,
Yeah, hello. Do you want me to answer the same question about when you know it's time for you to raise funds? Okay.
No, I'll be asking you a different question entirely. Yeah, okay. I was initially going to ask you a different questions, but you can just drop a point to say something on when is it right for you to raise funds for your company. for your idea.
Sure. When we look at companies, because we invest in companies super early on, we're typically looking at for a general sense of whether they've built a business. I mean, a lot of people come to us and pitch ideas, just like Mr. Jaga said, but we don't typically take those pitches too seriously. We focus more on ensuring that we can enable them to be able to be successful as a business. So what does that mean? It means that they've had at least one customer. It means that we understand what it takes to serve one customer. It means that we understand how many more of those customers exist in the world and what it will take to get them on board the solution. And that number is sufficiently large that we would be able to make a lot of profits funding you to go after that customer base. So that's generally how we think about that piece. I don't know, is that clear?
All right, I think I need to give some more light about this because I told you there are different concepts. You know, the model an angel investor will look at is not the same model and a VC will look at. And first, for example, for an angel investor, he will tell you that, okay, you must have a business plan, you must put together a good pitch, you know, to capture his attention and
Okay.
So are you there? Are you?
No. You know? Okay. So I was going to ask Inyolua.
Jega, thank you. Can you please continue with what you are discussing? Thank you.
All right. So what I was saying was that for an angel investor, he will be looking at a solid business plan, put together a great pitch. You have to capture his attention. You have to look with the promising data, and also like he wants to know the company's current situation and also future potential, and also in terms of exiting. And he needs to look at all those things. But for a VC, it's slightly different because VCs look at mature companies. They look at companies whose angel investment will want to like have more to say. Imagine like your day-to-day operations. You know, a VC normally attains a certain. They look at scalable businesses. They look at what they need to satisfy with requirements, and maybe you have to now look at how you can be able to accomplish those needs to convey the reason why an investor should love in your business in the first 5 minutes. You understand? So that model is another different. That's why I was telling you that there are different perspectives to raising funds, different perspective. But some investors will even invest in you with an idea, because I've come across over 10 businesses that have gotten investment from idea. They don't even have an MVP. It's on the laptop, and people invested in them by giving them the startup capital to kickstart and launch it.
Oh yeah. So thanks for that. I really appreciate the awesome pick on different perspectives of the angels, the VCs, and the when it comes to bootstrapping too. And I would like to go forward. I would like to go forward into asking Inye about the fact that determines how much choice. I understand that you have raised with Andela, with Florida Wave, you are doing the same thing with Africa Future, but in a community-driven manner. And I would like you to give a perspective on how much a startup or a business founder can raise? What determines? What are the factors that determines how much is it to be raised? And how do you gauge those factors? Is it by some metrics or some other means?
Yeah, that's a great question. So the rule of thumb when I'm working with startups I want to raise, particularly at the seed stage, is first of all have a clear sense of what the next milestone before you raise again, or maybe before you turn profitable will be. So for some people that might be profitability. For some people it might be getting to a magic number of revenue. For some people it might be achieving a certain partnership or getting to a certain scale. So figure out what is that milestone I need to be able to raise the next round. Then the second thing that you now have to do is how much money will it take for me to get to that milestone? So objectively speaking, how much funds do I need to be able to get to that milestone of revenue or user number or etc. And then finally, how much equity am I willing to give up to get there, right? On the basis of a bunch of factors, including your level of experience, what kind of connections you have to money, and what ownership level they're comfortable with, and all sorts. So when you consider all those factors, you then leverage that information to help you put together a pricing model for your startup. So obviously you have to raise the amount of money that helps you get to the next milestone. And I don't mean the amount of money it takes for you to build your whole solution, just the amount of money that helps you get to the next major milestone. And then when you have that, you now have to obviously consider it and go out into the market and see how much people are willing to take for it. Now, a lot of people will tell you they want a majority percentage or they want above 50%, but I always advise founders that a good one will be about 20 to 30%. If somebody's asking you for 20 to 30% in exchange for the amount of money you need to get to the next milestone, that's a good offer. Maybe if you can get it down to 10% or no percent at all, that's also very good. But basically, it's that combination of factors that helps you determine, what the plan for you is basically. And so, like I said, it will be those three things. Number one, thinking carefully about how much do you need to get to the next milestone. Number two, how much percentage of the company are you willing to give up? And then number three, how does that combination of two factors affect valuation, given where your peers are at in the industry? So that's what I advise.
Wow, thanks. Thank you for the point you just spoke about on what determines how much to be raised, understanding your milestones and things you need to get achieved and get done, and understanding how much you need to achieve that milestone, and going out to find out those who will be able to uh, take on it. So right now we have Maya around, and I would like to introduce Maya. Maya Organ Famudu is the MD at Aggressive Capital. She's right here with us for this session. She leads the efforts at Aggressive Capital, a $10 million venture capital fund targeting early stage startups across sub-Saharan Africa's key tech markets. She also founded Aggressive for Good, a non-profit focused on cultivating technical talent and resources for the African startup ecosystem, as well as Aggressive LLC, a market entry market operations firm that has assisted more than 50 international companies to enter and operate in Africa. And they've done collectively, they've done more than 40 deals on the continent. And she's also a Forbes under 30 under 30, and she has worked in private equity research. She has worked at JP Morgan after completing a Cornell pre-law program and attending Pomona College. Maya, welcome here. Can you say hi?
Thank you very much, and I'm so glad to be here.
Wow.
I don't have the strongest internet where I am, so apologies in advance for any cut out.
Thanks for coming. Um, we'll get into this question, and I would like to ask Maya. Okay, I checked through your portfolio at Progressive Capital, and I noticed a range of companies in fintech, in biotech, payments, uh, supply chain, and few other fields. And I would like to ask, can you give a description of an ideal startup that will be funded by Aggressive Capital? An ideal startup, how would you describe an ideal startup that Aggressive Capital is willing to back on?
Yeah, I can. And
Yeah,
I would
thanks.
also say we're seeing so many different types of innovations and so many new market opportunities given COVID and everything that has been happening in the world. And so I want to say what is a market opportunity and an ideal startup today, based on the information we have and what's happening in the world today, isn't necessarily going to be the same 1 week, 1 month from now. So a lot of things are changing, and coinciding with that change is the specifications of our investment strategy. And I think that's very important for any investment fund, and of course any company, is to pivot with the macro and the microeconomic changes that are happening in the world. But as of today, right now, what we look for is a pre-seed to seed stage technology company that is post-traction. And what that means is the company has sort of proven product market fit through its core metrics, whether it be number of users or revenue growth. It has either recurring revenue if it's charging people, or it has, if it's an app, an online platform, it has, that growth, that meaningful 30% plus month over month growth in its core company metrics. It's also tech enabled, so it is a scalable technology solution, but because it's targeting the African market, it has likely some element of offline implementation. It's also targeting a billion-dollar sector. So that means the total addressable market, the total number of people, likely, like you have the total addressable market, and then likely 10% of that times the charging price of whatever product they're selling. That number can get up to $1 billion. And they're early enough where our $200,000 to $400,000 ticket size can achieve about 10% ownership in the businesses where we're investing. As far as the sectors, we mainly do Nigeria's traditional tech-enabled solutions targeting Nigeria's traditional billion-dollar sectors. So like agri-tech, financial services, telecommunication solutions, and oil and gas or energy tech. However, given the opportunities that have come about during COVID, we've also incorporated health tech into the companies that we're actively investing in. So it should be targeting one of those sectors, or if there's a new market opportunity that will produce the same dynamics of what we're looking for, we're looking at that as well. As far as the team, we want at least one technical co-founder, and we want, through all of our interactions and our diligence on the founding members, since we're early stage enough where we're mostly betting on the team, the company needs to check out, as in they need to do good business with their peers, they need to do good business with their former investors, their employees have to have good things to say about them. It really has to be a bet on the founding team, and the research that we do needs to pull out that the person's a good person, that gets stuff done.
Oh, thanks. I think I got some things from that, where you mentioned that an ideal startup that will be funded by Aggressive Capital will not just be one that solves the African market, but it's also a traditional Nigerian company that provides tech solutions to the traditional problems faced in Nigeria, and also targets $1 billion market. That's a whole lot of opportunities to tell you. Okay. Thank you. You appreciate it, Maya. Thanks so much. So I'll be moving on to ask E again another question. I've heard him speak. I've heard you speak a lot about the earliest stages of and working with Jeremy to co-found Andela, and I would like to ask you, like, how do you achieve an optimum equity split that allows you to get the maximum time commitment from your co-founders and um, allows you to also keep them motivated working with you in the long term. E, you're on.
Hello, was that for me? Yeah. Yes. Can you
Hello.
hear me?
Hey, yeah, you.
Sorry,
Yeah, very well.
I got a call that distracted me. But I heard your question, which was, how do I keep my team motivated? Right? Can you hear me?
So I was asking, like, how do you starting out a company? Yeah, I can hear you clearly.
Fantastic. Yes.
I can hear you
So
clearly.
yes.
So
So
I
please
was going
just
to
repeat
ask,
the
like,
question. Yes.
when starting out a company,
Yes.
sure, I got you. Yeah, starting out a company, how do you achieve an optimum equity split that allows you to get maximum time commitment from your co-founders and still keep them motivated in the long term?
Yeah. So the way I think about equity, first of all, I have some ground rules. Everybody who works with me should get at least 10% of the company. That's what makes them a co-founder. I also like to work with people that I know are committed to the idea, and I have trust with. So I'm not super worried too much about them betraying or backstabbing or so on and so forth. Even if there are challenges, right? We have a very clear exit agreement because we work on the basis of something we call vesting. So everybody gets
Yeah,
10%, but you still have to work for that 10% over a period of 4 years. In the earliest days, what I look for in my co-founders is a sign of commitment to the project. You get what I'm trying to say? So they need to be
yeah,
fully
very well.
committed. They need to be fully committed to the project, be willing to make some sacrifices for it and stuff like that. So that's the main thing that I'm looking for.
Well, thanks, and you appreciate it. I really love the point that you made about investing, and I think there was a time Michael, the CEO of YC, was mentioning something about investing and cliffs for co-founders starting out because, uh, to be sincere, most co-founders starting out businesses and startups are usually not well informed about equity. Okay, thank you very much, Inyolua. So I'll be asking both Maya and Ibrahim my next question, and I'll be asking them that, okay, for for a company just starting out, how much equity do you think investors and angels should have in the business? I think I'll go with Ibrahim first.
I didn't get that. How much do was what?
How much equity do should investors, whether VCs or angels, should have when a company is starting out and you want to involve them?
Like it's first stage friends and family of funding, correct?
Yeah.
Okay. I'm happy to respond to that one. I think that a founder always wants to be thinking backwards. So if you have a hardware company and you're aware of the fact that you're going to need to raise, 2 times, 3 times, 5 times, 10 times more than a pure software play business, then the amount of capital you're going to have to raise over the life of your business will be more, and you probably will likely want to consider debt options or things that will not seriously dilute your business, given the traction might be the same as a software business, but you're going to have to give away more equity because you'll be raising more. So one, it really is depending on the type of business. Is it hardware versus software? And the other thing is, working backwards, you know that you're going to have to, so you build out your model, and of course, none of these things actually plays out as fact, but you want to have some general reference points as, okay, you'll probably have 3 to 4 funding rounds before you reach profitability, and likely you want to end at 50% or 51% ownership of your business by that time, or something along those lines. You definitely you work backwards. I'd say by maybe Series A, you'll have given up 25-30% of your business. By Series B, another 25-30% of your business, et cetera, et cetera. And so the friends and family round, I wouldn't say that there's a tried and true specific number, but it's really based on, are you a serial founder? Is this the first time you've started a business? How much money do you need to raise? Do you have any traction? Do you have any metrics that you've started building on yet? And all of those things can really go into your initial valuation price. And yeah, I would say ideally less than 10%, because at your pre-seed and your seed, you'll probably give away another 10%. And so you'll come up to your Series A having given away a total of between 20 and 30% of your business so far. And you want to be very careful. Angel investors, I've seen a lot of really crazy things happen at a company's first round of funding, where they somebody's giving them a $50,000 check and asks for 50% of the business or something like that, and they don't realize that negatively incentivizes investors to invest in the company down the line, because they're like, this founder's about to have no ownership of this business by their seed round, which means that they're probably going to walk away from the company or go start something else. So it has to be a play on both the founder and the asking, or the valuation that they can ask for based on their previous experience and how much traction the business has had, and then also the size of the ticket relative to how much they need to raise total to reach profitability.
All right, thank you. I think Maya has made a very good point there about the seed round. But Kinley, I find a lot of people are so caught up with idea and product alone. They don't pay attention to the process of making it scale, which financiers actually view importantly. And there's a saying that says nobody likes eating an empty restaurant, but many financiers are interested in and choose which option are interested, and they have to choose which option works for them. So most of this varies based on the perspective of that business. As I mentioned earlier, a lot of things happen based on your MVP. Everyone has its own different business model, and it's about your product and your value proposition that will help sell you and also attract the right investment for you, which you intend to achieve. Some at the kick of their product launch, once they start bootstrapping, they realize they can move further. They go meet an angel and they raise whatever they want to raise, and before you know it, they like to go back. They can't even allow more capital to scale up their operation and achieve their goal.
Oh, thanks, Brian. Thanks, Jega, for that which you just informed us of about how much equity should investors have when starting out and when investing in little business and startups. And I would love to ask the next question. I understand that you had companies before Andela, before Florida Week, and even while you were still a student at Canada. And I would love to ask, this is for first-time funders, actually, first-time funders. How do you deal with legal shortcomings when starting out? Starting out, there'll be so much that you won't be aware of, but you have to gain by experience. So from your own personal experience, what do you suggest, or how do you think first-time funders can deal with legal shortcomings when it happens?
That's a good question. I think there is always something to be said for having a good lawyer. I've learned that lesson multiple times, and obviously with the benefit of having done this a number of times, I always have legal and compliance on speed dial. And there's a lot of good firms that are willing to provide you great advice, especially at the earlier stages when they're not sure if you can afford it. I've had that privilege, at least in my own career. I worked with Labach Weinstein when I was starting my first few companies. They agreed not to charge me anything until I got to my Series A. I ended up paying them something small because I didn't get to my Series A. I worked with DIY Law. They agreed to not charge me anything until I raised the seed round. And once I raised the seed round, I actually was a small fee, and then I had to pay more once I raised the seed round. I also worked with Oric, which is a global law firm, on the same basis. So I would say, it's very possible to find good lawyers or even peers who understand the legal issues, and will be willing to advise you for free or close to free until whenever you become successful, and then your job is to be loyal to them when that happens.
Okay. I think you just stressed the need for first-time funders to involve lawyers for things that will be done when starting out their businesses. And this brings me to asking Ibrahim, that how can you involve legal parties when starting out businesses in Africa? Ibrahim,
Sorry, that
Ibrahim.
question. Sorry, I didn't get that question.
Yeah, I was asking, like, how do you involve legal parties when starting out businesses in Africa?
Yeah. You don't hide your idea. You register an IP or bring it out. And most importantly, at the takeoff, based on what Ian was saying, it's very important for you to have a lawyer handy so that you can be able to incorporate and decide, put up a structure around it, because a lot of people get carried away by the conceptualization and feeling that they have appetite to go solve that problem, though they don't put the house in order. And when money starts coming in, that's when you find out that crisis occur. And most importantly, I feel most businesses find out to miss that step, startups. So it's very important for you to look at how best you can be able to achieve that at the early stage, so that you can be able to define your bearing, understanding that X is for Mr. A and Y is for B, so that it will clearly define. And if someone is joining you at the journey, he will be able to understand you have a structure, your registered entity, and your team, and what you intend to achieve. Because I have come across thousands of startups operating without even registration, which is very, very, very scary. And I believe some of them get carried away by that. Some of them get carried away because they feel it's all about the solution. It's all about what they intend to offer. But crises occur when the going gets going. You understand? So it's very important for you at the foundation, so that it will be able to help you get a good structure, understanding, and also put confidence in your team, so that everybody will have a clear-cut definition of who owns what. And everywhere you're going, you go as an entity, to be able to have the concept of solving that problem that you intend to achieve. So having a lawyer handy is very critical to be able to solve that.
Yeah. Well, thanks very much for the take. We appreciate it. I would like to ask Maya, like, when starting out, you need to reach funding. We already established that fact. Now, I would like to ask, who should raise funds in a business entity or a startup? Look, we have the co-founders, which might comprise of the CTO, the CEO, probably the CEO. We have people who work with them, probably they are software developers or some other professionals. Who should raise funds? Is it the CTO, the CEO, or the entire co-founders team, or should it be the employees or the entire company altogether? Maya.
Great. So one thing I want to talk about, because everyone is so into this fundraising concept, but I want to just remind of a really great quote that a friend shared that is so poignant and accurate. Once again, the sweetest money you will ever have is that from your customers. The sweetest money you will ever have. Why? Because when you make money from your customers, you never have to give it back. When you make money from your customers, as long as you give them the product, that money is yours forever. That money you can do whatever. You can buy you can pay your salaries, you can do this, that, and the other. With an investor, every penny that I give you, I don't want just you to give me my money back. I want you to give me 1,000 times my money. I give you 100,000. I want you to return 1,000 times that amount. If not more. So we're looking for those companies that succeed in our portfolio. We're not just looking for a small percentage back. That time, that repayment time is real. And be mindful of the percentage of your business that you give away. That's how much you have to return at your exit, at the time of your exit. So I just want to remind people, don't just take money from anyone. Don't do it because it's trendy and because it's popular. And so be mindful of the people that you're investing with, because you're essentially getting married. You're going to be with them until the time you exit your business. So be mindful of the people that you're accepting money from. So I just on that note, and the last thing on that is, don't announce your raises until you're at a point where you can where you have so much money, you can beat out your competition, that you have incomparable amounts of money. Because the thing that I see happening is people do raise money from investors, and then they decide, oh, we raised 500K, let's announce it online. They announce it online, and then all of a sudden they have 10 competitors in the space, and their vendors have increased the price 50%. So just be careful, be mindful of that.
Yeah.
And
perspective Maya was sharing, because there's a say that says there's no free money, even in free time. And once you collect money from someone, you should be able to know that it comes with a heavy price. You have to make sure that if I give you my money, I want to see an ROI. You understand, return on investment, whatever I invested. So no matter how you seek to fund, how much you seek to fund you, it's very important that you don't see them, those investors, as a source of funding, because you have to show that you draw up what you want to be involved and strengthening you on top, because it's either through you bringing more skills or opening more business opportunities, because resources and networks help to help you grow. Because every founder should be able to look and be open to this, because a lot of startups don't look at networks. They don't feel that it's all about, there's a buzzword, as Maya said, about funding. Everybody wants to fundraise, everybody wants to be on that trail. But friends and family play a very important role in whatever you're trying to do. And you should also be friends with, as I mentioned earlier about the issue of the corporate lawyer, you should also be friends with a lawyer, because in business, contracts and should be handled well. And if you can't even pay those lawyers, you should be friends to one. At least you can leverage on them to give them tips and appreciate them as they're helping you. And also you should be aware of the trends, because a lot of people startups are not flexible enough to be able to repose their idea based on circumstances that deem so fit. And for example, we're in COVID now, and a lot of funding is tied to various problems emerging from it. And so you have to look at how best you can be able to adopt to address the inspired problem that is coming up on that. I just wanted to just add that.
Sorry, one more piece of perspective for those who are wondering about where to start from in terms of making money. A lot of the initial capital that's needed in a company, when you really dig into it, and we see quite a number of companies, you'll find that there's very little you actually need straight up cash for if you're resourceful. For example, whenever I hear people pitch, especially at the seed stage, one of the things they say they need is a developer. Now, if a developer is not part of your founding team, doesn't have equity or interest in helping you build software because he's a part owner in a technology company, you have much bigger problems, in my opinion, right?
Yes.
So at the very least, you should be able to get someone to build the software for free. Mr. Jega spoke earlier about Amazon credits. I mean, those can help you get your cloud services up and running for almost free. You don't really need an office space when you're starting out. You need to get a product in the hands of customers as quickly as possible. And the other side of it is also that your first customer right, is really the real win, just as many of the other speakers have said. But more practically, even when I start businesses, I try my best not to build anything until I've secured a customer who's willing to pay or use the product. And I find that if you do that, you initially end up looking like a contractor, but over the long term, you can find that you're able to get better terms with competitors who might need the same technology as your first customer. So that's just a practical way to get started. Find the customer first who is willing to pay for the work. That reduces the burden on you. Look for people who are willing to put in sweat equity into the work. That reduces the financial burden on you. And I really do believe that most businesses can be started with very little funding upfront when you think about it
Okay.
that way.
Yes.
Thank you.
And to add one
Right?
more thing onto what you said. Yes, absolutely. I 100% agree with what was said. And on the note, because I've also seen founders go the opposite way. So what E said is absolutely correct. Be mindful, but when you have your first customer, they tell you what you want, and you build out the first product, ensure that you're not building something new. You're not a consultant. Not every time somebody comes with a new need, you're like, okay, well, we'll build this. Okay, well, we'll build this. There's a difference. What you want to do is have one product that you can sell to 1,000, 100,000, a million, millions of people, not unique different iterations for every person who's coming. That's not a scalable business model. That's not a tech company either. So there's that balance of, yes, absolutely, exactly what E said, but don't do that 100, 1,000 times over. Don't build something new for every new person that comes. Find a market, a scalable market for that first iteration, that core product that you're building. And to go back, I don't think I answered your actual question of who should do the fundraising. But to answer your question of who on the team should do the fundraising, we have a very meritocratic team, which means if you're better at fundraising than I am, then you will be the one doing the fundraising. If you have consistently better ideas than me on how we should position ourselves to investors, of how we should be building this product, then that's your role. So we're very, very flat. You can ask our team. We're very, very flat. And so right now, one of our analysts is actually the core person who's going to be assisting me in our fund to fundraise, because she's proven time and again that she has the ability to do so. And that will be reflected in her growth within the company. So I don't think, as people are going out, I think that the person who's the best at fundraising should be the one fundraising. And of course, they should be an equity owner. So there needs to be one core owner of the business, because if your salesperson's making decisions on the terms of your investment and they don't even have rights inside of the business, that's not going to work. But if you find your core, one of the core owners of the company, plus whomever is, on the outside, if you need to call or hire somebody specifically for supporting that role, investor relations, something like that, that's okay. But I really think it's not going to be just the CTO. It's not going to be just the CEO or the CEO. It should be whoever is the best at people relations, at following up, who likes to, keep in touch, who knows the product best, and who can sell it the best. That's the person who's ever most successful at fundraising should be the one fundraising.
Yeah. Thanks for that take, Maya. I think it's getting the best person who do the job on the team to actually do it. Thanks for the tip. You appreciate it. And lastly, I would like to ask Inyi Oluwabuiji, while fundraising, you need to build your company, you need to build your product. How do you build and fundraise at the same time without distracting building with fundraising? Please, can you give us your take on that just quickly? Thanks.
E?
E?
I'm happy to answer that in the meantime while we're waiting for him to come back.
Hello, sorry.
Oh,
sorry, I apologize.
Hello,
I got carried away. Do you mind just helping me with the question again? It's a bit noisy. Yes, I have to step in and out.
Sure, that's no problem. That's no problem. So I was asking, like, while building the company and reaching at the same time for an early stage enterprise? How do you manage building and raising at the same time without distracting building with raising? Understanding the fact that there are few hands doing the job all together in the company. So how do you do the two together so that you don't distract building with raising, so that you
Well,
can reach product market fit as soon as possible? Please,
yeah.
would love that
So,
you give your take on that quickly.
yeah, very quickly. So, first of all,
Yeah, thanks.
I believe only the founder should be raising, only the CEO, sorry, should raise. As an
Okay.
investor, I generally don't want to hear from everybody. It's important that I hear from the CEO, especially if he's making decisions, because I'm not just investing in the business or the concept of the business, I'm also investing in the management. And that's largely going to be the CEO's responsibility. So only the CEO should be raising, everybody else should be working. Second of all, I think that it will distract you and there's nothing you can do about it, but you can make it as easy as possible for yourselves. And the way you do that is that you provide, you create a you need to create a process that makes it very easy for you to do this in a very short period of time. That means that you do a lot of prep work before you go out and pitch. You have your data room ready. You have all this stuff ready. So these are the things that really matter when you're going out to fundraise. Guys, I'm really sorry, but I'm taking time away from my family. I have to go back. So I really enjoyed you guys having this conversation. I think it's an amazing one. And
Thank you
I'm
very much.
happy to be helpful. So just send me messages anytime. Okay. Thanks a lot, guys. Have a
Thank you.
wonderful day.
Thank you
Thank
very much.
Yeah.
you.
Thank you. Our dear viewers, we have come to the end of this panel session. We had such amazing and awesome set of speakers and accomplished people talking with us on this panel today. We appreciate your presence and we appreciate our panel members too, Maya, Jega, and E for giving us their thoughts and their insights on building systems, building enterprises, building business, and making things work out for ourselves, for our ideas, and for our companies. We have come to the end of this panel session, and you are all appreciated. Thank you, He. Thank you, Maya, and thank you, Jega. We are so grateful.
Thank you so much for having me around, and I really appreciate it.
Thank you, Jega.
My pleasure meeting you, Maya.
Yes, great meeting you as well. And thank you guys for putting this together.
Thank you, Maya.
And if people want to if people want to be in touch after, I respond to 100% of my Instagram DM. So contact me at Mayanator, MAYANATOR on Instagram, and I will respond to you immediately.
Oh yeah, thanks. So guys, if you need to reach Maya, you can reach her on Instagram. You need to reach Ibrahim too. Ibrahim, please can you tell us how you could reach you?
LinkedIn, please. On LinkedIn, Mohammed Ibrahim
LinkedIn.
Jega. My name is Mohammed Ibrahim Jega.
Oh yeah,
LinkedIn.
Oh yeah, Ibrahim Mohammed Jega.
No, Mohammed.
Yeah, Jega is actually very participative on LinkedIn. Mohammed Ibrahim Jega.
Yes.
Yeah, that's right. Thank you very much.
Thank you so much.
Thank you very much, Jega. Thank you very much, Maya. And we have come to the end of this panel session. So now Chika and Wobi will be going live now, and we'll have him in the studio just now, and he will be speaking now. Thank you very much. Thanks for today. Stay cool.
Thank you, guys. See you.
Thank you.